Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned into On Trend, the show designed to keep you on the right side of the trend. So it is Tuesday, February 12th, 2 days before Valentine's Day. Don't forget, folks. We're going to look at QQQ and SPY holding their breakouts, but IWM, small caps, are outperforming. They're going to look at some industry group ETFs that I think are holding the key going forward. We're focused on the payments industry, those stocks. We'll look at weakness in media land, and then I got some stocks to watch. The short-term uptrends are still in play. So for the short term, I continue to be focused on the immediate uptrend, which started in late December and continues to move higher for the S&P 500. And I'll get to the SPY, QQQ, and IWM charts next. Now, we haven't seen this short-term uptrend evolve into a long-term uptrend because we still haven't taken out the December highs, and the 200-day and breadth indicators have yet to turn. But I am focused on this short-term uptrend, and what I'm seeing is very limited selling pressure on these pullbacks. So the indicator here is 80%. That equals advances minus declines divided by total issues. And I've got it for the S&P 500, S&P Mid-Cap 400, and S&P Small Cap 600. And what I'm noticing here is, first I was seeing less buying pressure because we couldn't get back above that plus 70% level in these three. But even though we got less buying pressure, we got even less selling pressure. Because if you look at the downward dips when we had declines outpace advances, we got to around minus 30% in the S&P 500. We didn't go below minus 25% in the S&P Mid-Cap 400, and we bottomed out around minus 35% as a guesstimate there. But we didn't get below minus 50% in any of them. Selling pressure was very contained over the last 3 weeks, basically. And so that keeps the bulls in power here as far as this short-term advance is concerned. Now we look at these same indexes and we look at the percentage of stocks above the 20-day EMA. What I've got is a horizontal line at 70 and a horizontal line at 30. And what I'm noticing is continued strength because we remain above 70%. Haven't been below 70% since that early part of January. And that is true for mid caps as well. Small caps are a little bit weaker because you can see a couple dips below 70%. But until we start to see two of the three move below 70%, the broad market remains strong because the vast majority of stocks are still above their 20-day EMAs. Now, if we look at the big three major index ETFs, SPY, QQQ, and IWM, we can see that SPY here broke out of a pennant formation about 2 weeks ago, and that breakout zone turns the first support level around 265, 266, and it is holding. Yeah, we had a little bit of a gap last week, but then firmed on Friday, kind of did nothing on Monday. But the point is, this little pennant breakout is holding, and it's the dominant short-term pattern right now because it's a bullish breakout until proven otherwise. So what would prove it otherwise? Well, if we go below 265 and RSI moves below 50, if you'll notice, RSI has been above 50 since the early part of January, and that means basically the average gain is outpacing the average loss over a 14-day period because I'm using 14-day RSI. Now we look at QQQ, we can see a similar pattern here because we have as well the gap and the breakout. Had a pretty deep fall, well, deep, yeah, relatively speaking over the last few days. But, we ultimately held this breakout zone here at 165, 166. So I would stay bullish. And if we break 165 and RSI goes below 50, then we have a short-term trend reversal possible. And then IWM. IWM is holding up better than the other two, and I'll show that in more detail next with a 30-minute chart. But if you look at this, we had a little bit of a flag and then a flag breakout there. And we have kind of, what could be a pennant wedge and a little pennant wedge breakout there. So IWM is holding up very well. And you can see RSI is at 65 and it's been holding above 50 since early January. So IWM looks the strongest of the three right now. So this chart here is 30-minute bars. We have SPY and IWM, and then we've got the IWM-SPY ratio, also known as the price relative. And if we look at the SPY chart, look how we broke below these lows here on 3-4 January, whereas IWM held above them. So that was relative strength there. And then IWM and SPY moved higher, and they started kind of correcting here. And you can see in this phase in February here, SPY actually moved below that late January, early February low, whereas IWM held it. So IWM was showing relative strength on that pullback that we saw last week. And then you can see now that IWM is closer to these highs than SPY. So in that regard, it's showing a little bit of absolute strength. And then we can confirm what we're seeing on the chart with the price relative, because we see a higher high there at the end of January, and we just edged above that high yesterday. So that price relative continues to work its way higher as IWM outperforms SPY. Large cap biotechs weigh on IBB. Now I want to focus on a few industry group ETFs that could be key to the market in the coming days and weeks, because a couple of them are stalling, and depending on the direction of the move after the stall, that could influence the market. And the first one here is retail, and you can see retail has been stalling here since actually the early mid part of January, just moving flat, but it is holding this support level. So you watch 43 down and 45 up. And I think if we break above 45, that's going to be a positive for the broader market, especially the consumer discretionary sector. And that could lead to a test of that 200-day. And you can see RSI can't get above that 60 level, so it needs a little breakout there. So we have two levels to watch in RSI, 60 on the upside, 50 on the downside. Another one is home construction that I continue to watch. Now, it's still in an uptrend, all right? This is basically the uptrend, and we got a clear support level there at 32-ish to watch. And if we close below that, then we have an issue. Now, shorter term, what I can see is, another type of a surge, and this looks like a bit of a flag, if you will. And if you can get back above 34, that keeps this little upswing alive. So I would be watching housing closely as well. Regional banks are another one to watch closely, especially when it comes to small and mid caps, because if you look at the top holdings in IWM, the Russell 2000 ETF, you'll see financial services at the top. So a lot of little banks and financial services companies in that ETF. But if you look at it here, KRE had this huge advance, and then it kind of just stalled there and moved flat. And it looks kind of like a flat flag. It's not a picture perfect flag, but look at that. We're above that high from late January. So we're showing some relative strength in regional banks as they continue to work higher. So I think that's a positive for the market overall, at least short term. Biotechs are also a group to watch here. This is the IBB ETF, the iShares Biotech ETF. And you can see the top holdings there are the big biotechs, Celgene, Biogen, IDEC, Gilead, Amgen, and so on. And if you look at the chart pattern here, you got this big surge and then kind of a consolidation. And it looked like a pennant, and it looked like we had a pennant breakout, but then we fell back. And that was because Biogen IDEC, which is 7.72%, had a gap down and a sharp decline. But we're holding support here at 106, but as I'm going to show next, if you look at the top 5 components, their charts are not that promising. Now, somebody asked me about inverse head and shoulders patterns that they're seeing places. This is not an inverse head and shoulders, all right? Sure, it's got the shape, but an inverse head and shoulders pattern is a bullish reversal pattern, and it needs to reverse a downtrend. And if you look at the prior move down, it's basically this, because this is the pattern, and the pattern is much bigger than the prior move down. So you can't have a pattern that is bigger than the prior move down. I just think that doesn't work for me. So I would just ignore that. I think head and shoulders, most of them you just need to ignore. It's an overused pattern. I don't think there's, and a lot of them do tend to fail. I don't have any numbers on that. But, you know, regardless of the pattern, you can see a surge, a consolidation, and if we break out here, then that argues for a continuation higher. And if we break 106, that's going to be negative. Now, the other biotech ETF is the XBI, which is the biotech SPDR. And if you look at the holdings here, you're probably not going to recognize many of them. Sure, Celgene is in there, but it's 1.61%. And the rest of them, I'd be hard-pressed to name these companies. And if you look at the pattern here, they got the surge along with the rest of the biotechs and the market, and then the consolidation, and then the breakout. And the breakout is largely holding here because that pullback was not as deep as the pullback in IBB. So this one still looks bullish as long as, say, it holds 81 and RSI holds above 50 there. So when you're looking at an ETF that is dominated by some or a few large caps, it's important that you understand what's happening with these large cap stocks. So here are the top 5 stocks in IBB, the biotech ETF. So there's IBB, the first candle glance chart there. And you can see that, you know, basically we have a consolidation just below the 200-day. And you look for the direction of the breakout here. So if you look at the top holdings, well, Celgene has a buyout offer. So it's probably dead money. It's just moving flat. It did move up yesterday. There's Biogen gapping down below the 200-day and failing at these highs here. So that doesn't look so good. Gilead is below the downward sloping 200-day. So it does not look good. And it had a gap down last week. Amgen has been underperforming and is below the 200-day. And Illumina, excuse me, has been trending lower since October, and it barely had a bounce. It didn't even hold its bounce. It's below its January low, so it is really underperforming. So these stocks are not performing well, so that probably makes XBI the better play of the 2 biotech ETFs. So if you're looking at ETFs that are weighted by market cap, that's going to mean that the big stocks within that ETF are going to dominate. And so I think it's important that you know what the big stocks or which stocks are dominating the ETF. And you can do that with Google. So I search for XBI ETF holdings. And if you scroll down this web page, there you're going to see US SPDRs, and that's the Fund Family website. And they will have the most up-to-date holdings. I also went to the iShares website to find out the biggest holding is an IBB, and there you can see those holdings. Focusing on the payments industry. So what I did was I found some stocks that I wanted to focus on. I picked 8, and you can see them here. First Data, Global Payments, MasterCard, PayPal, Square, Visa, WorldPay, and at the top was Euronet Services. And I put them in a chart list. And once you have a select group in a chart list, there's lots of things you can do with it. For example, I've got this view list as drop-down menu at the top there. And so I can select that drop-down to view this list in a number of different formats. So I can do 10 per page, candle glance. You can put them in RRG to see relative performance, seasonality, market carpet, and correlation. So if I click market carpet, you can see I can just view raw performance together there. And so I can see which ones are leading over the past. We'll pick 30 days here. So you can see First Data is up 47%, Square's up 33%, and then the laggard is Visa, up a mere 7.5% over the last 30 days. That's crazy. Of course, that just is basically the rally that we've had since Christmas. So if we go back 60 days, we get a bit of a different picture. WorldPay and Visa are flat, and Square is up a little bit. But my favorite way, of course, is either 10 per page, or if you do a candle glance, you can get them all on one page, and then you can do your analysis looking at all these charts together, and you can make a decision on which one is leading, which one's lagging, which one might be breaking out. So if you look at these charts here, we've got Euronet Services here, and it got a big breakout there. So it's kind of gotten way ahead of itself. You know, there's maybe a playable breakout there in early January. You know, maybe there was a tiny consolidation before this other breakout. But at this point, you know, broken resistance turns into support. And if we get a pullback to that area, it might be an opportunity. Now, First Data is the interesting one here because it's not an island reversal, but, you know, you've got a gap below the 200-day and then a gap above the 200-day, and then you're stalling. So I would put this on my radar, let the dust settle, and maybe there'll be a pullback play here. Now, Global Payments may be one of the more interesting ones here. Global Payments, Square, actually there's 4 of them that are quite interesting. And so what I can do here is I can go to a larger chart. I'll go to 10 per page so we can look at these in more detail here. So the first one that I think is very interesting is Global Payments. And the reason it is because it's got this big surge here and then kind of a consolidation. Yeah, it was a pennant there. You broke out, you fell back, and now we're back above. But I see a lot of support there around 110. So this one is looking promising. Next, we have MasterCard, and it's kind of gotten away with this gap and this surge, but I think it's one to put on the radar for a pullback. Look at PayPal Holdings. It is kind of consolidating near a 52-week high. There's the 52-week highs there around 94. Actually, that is a 52-week high. And then you broke above this zone here. And it's just kind of a messy consolidation. Earnings have passed, but I don't see anything negative on this chart. I see more positives than negatives. Another interesting one is Square. Now, this is the higher growth stock within the space because it's starting from a lower level. But you can see kind of a wedge type pattern here and then the breakout. And now we've got a bit of a pennant forming. Tried to break out yesterday but fell back. But I would still watch that one and stay bullish as long as it holds above 68 there. Visa is another one. You can see a lot of a sell-off yesterday because Visa was up above 142, but then closed and fell back below 141 by the close. But if you look at the chart here, you know, it's very choppy around this 200-day, but the 200-day is rising. All right, so I think the bigger trend is up, and I would expect higher prices from Visa. And the reason I'm focusing on the payment industry is because I think, or from what I read, you know, on IBD, on other websites, that there's a secular growth story at work here. So I think it's one we want to keep on our radar for potential playable pullbacks and relative strength. And then this one is WorldPay. Yeah, I don't see too much here. It's still below the 200-day, so it is not quite in the leadership group. Now, there's one more thing we can do here with this list. When we go into candle glance, I'll then go into a default style. Let's just pick 6-month candle glance charts. And then if you can add an indicator to this. So I could add the scooter or I could add the PPO. And if I'd have put a PPO 1 201, I will see the ones that are the furthest above their 200-day EMAs. So we're sorting by that PPO value, and you can see the PPO here on the left. It's at 26 for Euronet. So there's 0 on that PPO. So it is the furthest above the 200-day. And I'll go ahead and put on my line marker here. There's the 0. So there you can see you move above the 200-day EMA and you're far above it. We can see squares above the 200-day EMA. It's the third best performer in that regard. PayPal is above its 200-day. MasterCard, Visa above the 200-day. And then when we get down, we can see WorldPay is just above its 200-day EMA. The one I was showing before was the SMA. Say the truth, it doesn't matter which one you use. They both work. Sometimes one works better than the other. Sometimes the other works better. Media land. The group I am seeing weakness in is the media group. And here I've got 5 media-related stocks. We got CBS, we've got Disney, we've got Interpublic, which is advertising, we've got News Corp, and Viacom. And only one of these is above the 200-day, and it's just barely above the 200-day, and that would be Disney. But I'm looking at the performance here recently, and it's still lower highs. And while the market, moved higher during this period, Disney looked like it was breaking out here, but now it's failing, and it got hit pretty hard yesterday. So this one could be vulnerable. If you look at CBS, you kind of have a support zone turning into a resistance zone below the 200-day, and the stock looks like it's rolling over here. We look at Interpublic. We can see a support zone that's broken that turns into a resistance zone around 23. And then we got that sharp decline last week, which looks like a breakdown. You could even draw a rising wedge if you're so inclined to do. Have a bit of a wedge breakdown there that signals a continuation lower. Then we look at News Corp. And there you can see a support break there. We got back above the support break, but look, we're still well below the 200-day and turned down pretty sharply the last 3 days. And then Viacom has a support zone turning into a resistance zone. And keep in mind, these aren't exact levels to the penny or to the 10-cent level. They're zones, okay? And we came back to this zone and we hit resistance a couple times, and it looks like we're turning back down. So this media group, or at least this portion of the media group, does not look very healthy. Weekly analysis. A daily chart for F5 networks, and it goes back 1 year or 10 months, and it's got 14-day RSI with the 200-day moving average. And if you look on this chart, it does not look that great because, you're below this trend line, you're below the 200-day, so it's looking more of a downtrend. Shorter term, what I'm noticing is you have a gap down, but you got back above the gap. And then I could mark a resistance zone here, and if we can get above that resistance zone, I wouldn't use that trend line as resistance, I would use this high here. So if we break 168, I think that would be a bullish development for F5. Now you look at this pattern, you say, well, this looks like a falling wedge. And a falling wedge is typically a corrective pattern or a channel after a bigger advance. Well, how do we figure that out? What is it? Well, if we look at a weekly chart, we can get a different perspective and see how it looks over the longer term. And look what we have here. We have kind of a resistance zone turning into a bit of a support zone here, around 150. We're below the 40-week moving average, finding a little support here. We can draw our wedge line here. Doesn't have to be perfect, but it looks like a big advance there and a correction. And the trend lines are just used to mark pattern boundaries or a pattern. They don't always match. I think what's key here is this high. All right, that's the high we need to clear to get this pattern reversed. and get this bigger uptrend resuming for F5. Another thing to watch for is I've just got 14-week RSI, and if it moves above 50, you can see here in November it moved above 50. It did here in late October. That didn't work out, but if we move above 50 here, I think that would be bullish for longer term RSI. This is 14-week RSI. Stock setups to look at. All right, the first one here is FNSR, and you can see that we have a big gap and a surge with a breakout to new highs, and then we had a pullback, started firming a little bit, and got another gap breakout. And if you go into the really granular level, you see a little bit of a flag, and it looks like we have a flag breakout. This pink line is the 52-week high, 255-day high. So we're very close to a 52-week high, clearly one of the leaders out there right now. And we've got an upward sloping 200-day. Next up is VCEL. Now, I must tell you, this is a biotech, I believe, so it's carrying some extra risk with it, but it held up very well. You can see when the market was falling apart in October, RSI did not become oversold. Similarly, it did not become oversold in December either. And what we have is maybe some sort of a cup with handle. And we have a nice little parabola annotation tool that you can use to draw that. I go 1, 2, 3, that looks like the cup. And if I go 1, 2, 3, that looks like the handle. And then I can draw some resistance there. I don't like drawing resistance in an uptrend because, to tell you the truth, you know, an uptrend, you're not supposed to have resistance. You're supposed to make higher highs. But my preferred pattern is this, you know, kind of pullback here. This kind of channel flag thing. And it looks like we're breaking out of it. I'll go ahead and close that, click yes to save. And then the next chart is Form Factor, and this is a semiconductor stock. A little more on the volatile side there. As you can see, it's a low price stock, which has more volatility by definition. But what we do have here is a higher low. We had a big surge and a breakout. Pretty deep pullback, but held above and got a breakout there here in late January, and that breakout's holding. So I would say as long as you hold 1450, that's a valid breakout there. Next up, we have Intuitive Surgical, and this one has a rising 200-day. You can see we got the big surge with the gap in between, and then a consolidation. And a consolidation after a surge, typically a bullish continuation pattern, and we got a gap and a breakout yesterday. So this one is looking bullish. Ionis Pharmaceuticals, this is another one of those cup with handle type patterns. You can see there is the cup, there is the handle, and this pattern was of course popularized by William O'Neill of Investors Business Daily. This will be another one of the more volatile stocks, but you've got a rising 200-day moving average there. Next, we have Hologics, and you can see that it is challenging this prior high. You got a little bit of a pullback working. Maybe it's a wedge, and if you get back above 44.5, that opens the door to a continuation higher. And next up, we have Wingstop. Even though the Super Bowl is over, people are still eating wings. And this is hit a 52-week high there in January, as well as October. And then if you look at the patterns at work, that is some sort of a wedge correction and a breakout. And then we have a smaller wedge and a breakout working there. So this one looks like it is headed towards new highs. This edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.